basis accounting versus cash basis accounting. My name is Taylor Maxwell, and you just graduated. Freedom! And you're ready to start a business. So congrats on graduating, but you've got a lot more work ahead of you. So you're ready to start a business. First, you're going to have an idea. Something you've always dreamed of, or maybe something new and fresh. Doesn't matter. What does matter is knowing how to finance this business and knowing the principles of accounting, plus the process of the transactions and recording and adjusting your financial statements. So there's two methods of keeping track of your finances, is the accrual accounting versus the cash basis accounting. So your accrual basis accounting is going to be when you recognize your revenue, so sales of products, when earned. So say a customer comes in and buys a t-shirt, so the sales of that t-shirt will be your revenue. And recognizing your expenses, so your use of supplies, so say rent expense when incurred. So accrual means just the accumulation. And with accrual, you'll have two principles that go hand in hand. So your revenue recognition principle and your expense recognition principle, or the matching principle. So your revenue recognition principle is going to be when you record your revenue when earned, not earlier or later. It's in that time period. Same with your expense. You want to match the process of recording the expenses as the same as recording your revenue. You want them to kind of go hand in hand, not same. You don't want it to be before, or you don't want it to be after. That could affect how your company looks if accountant is going through your financial statements. You want everything to be as accurate as can be, so there are no room for mistakes. And then there's cash basis accounting. So it recognizes cash when earned, so your revenues, and when cash is spent, so your expenses. So it's whenever, kind of the same thing, whenever somebody buys a t-shirt and you earn that cash, it's going to be you're earning your revenue, and it's going to be recorded at that time. And same with whenever your cash is spent, your expenses are spent. So whenever for the rent, you're going to have a yearly rent, and you're going to record it within that 1 month. As a whole, accounting has GAAP, generally accepted accounting principles, that aspire towards having prevalent, reliable, and comparable information. So accrual accounting is GAAP approved because it shows a clear statement of the activities and performance of a business. It illustrates the transactions for each time period and is easy to analyze compared to cash basis accounting. So it shows that the finances are reliable, and it is easy for them to compare each statement back and forth because it's illustrated in a sort of neat and easy way. Cash basis accounting is not GAAP approved. There are no adjustments, and it's just kind of one picture you get. You don't get a full illustration. So for example, Dominic wants to open a sandwich shop. He is renting a room to prepare the meat, which is $450 a month for 12 months. And Dominic sells $120 worth of sandwiches in a month. So when using accrual basis accounting, Dominic would record each month that he is paying $450 to the expense account. So each month would be $450 for each month rent. And he would record $120 worth of revenue. So when using cash basis accounting, Dominic would record at the beginning of a period $5,400 to the expense account, because he's renting for a year, so 12 months times $450. And he would also record the $120 worth of revenue. So as you can see, at the end of each month, the profit's going to be a little bit different compared to the 450 minus the 120 compared to the 5,400 minus the 120. So accrual versus cash basis accounting. Accrual is easy to understand and to analyze and to interpret for future interactions. For bank loans, if you have investors looking at the company, they're able to see kind of the history of the transactions through the accrual, unlike the cash basis.